We are live. Welcome to this episode of Tax Tips Tuesday, how you can eliminate your tax bill with using the big, beautiful bill. This is going to be fire. Come on in, bring your notepad, invite a friend. If you have a tax bill or you may have a tax bill, this is going to be for you, whether you're a business owner, entrepreneur, solopreneur, or somebody that just has high net worth, high income, or you plan to have high income, right? We all plan to have high income. So this is going to be incredible. Well, today we're going to talk about how can we leverage the tax code in our favor. And oftentimes you heard me talk about playing the money game. Many people, in fact, most people will actually play money. I call it money checkers. They make some money to pay some money. They make some money to pay some money. And that's what 95% of the population does because they don't understand the rules of the game. We have to understand the rules of the game and how to play this money game. I call it playing money chess. We got to understand and plan ahead 3, 4, 5 moves in advance so that when we have the money, we don't overpay our tax bill. Because, by the way, everything we do is above board. It's legal, it's moral, and it's ethical. We're not talking about doing things that, are flirting with the gray lines. We're saying this is the rules. We can use this strategy. And with this big, beautiful bill, however you feel about it, listen, this is not political. This is about the money game. So we're going to be based on numbers, based on facts. And my guest speaker is incredible. She is absolutely a master at the tax code. She calls the tax code a treasure chest. And I just love that because a lot of times we think about it and we think, wow, it is something that is punitive. Right, we have to pay these taxes and pay those taxes. Well, she calls it a treasure chest because there are so many golden nuggets there that we can leverage in our favor so that we don't overpay our taxes. So please give it up for my incredible partner, guest speaker, Miss Chris Carty. Take it away, Miss Chris.
Hey everyone out here in LinkedIn land. I'm Chris Carty. I'm a transformative tax advisor. So I teach my clients how to leverage the tax code to create lasting wealth. And today we're going to talk about that one big, beautiful bill. So there are so many different opinions on the bill. But as Leah said, this is not political. All this is about, it is the money game, right? Keeping more of the money that you worked hard for so that you can now create generational wealth. It's not about the politics. It's about how can I use this bill to help me to keep more of my money that I can then invest in more tax advantage assets to give me more tax benefits and to help me to create wealth for my family.
That is absolutely money chess. I love it. So before we dive into this, give everyone a little bit about your background and how you've come to this point to be an incredible strategist when it comes to taxes.
So I've been in the accounting space for more than 2 decades, but I really got into taxes in 2012 when my daughter got audited. So she was like, I think a year out of high school, working. She was married and they got audited and she expected me to fix it. She's like, well, you're an accountant, like fix it. And I'm like, well, accounting and taxes, that's like 2 different things, right? But I'm a parent and I love my kids. And as a parent, what do you do if your kid is in trouble? You figure it out, right? And so her getting audited forced me to figure it out. And figuring it out meant I needed to dive into the tax code. But as I researched to help her win that audit, what I was seeing was everyone is thinking about the tax code like it is punishment. But if you really read and understood it, it's not punishment. Yes, there are punishments for if you don't follow the rules, but there's so much in there. It is literally a blueprint to wealth creation. All you need to do is you need to understand it. It is complex, so many people can't understand it. So basically, I say the tax code is like being in a room of strangers where everyone is having fun except you because you can't understand the language. You have no idea what they're saying. Everyone is laughing, so you can't laugh because you don't understand it. what you need is a translator. You need someone who understands the language that's being spoken in the room, so that you can now understand it and be part of and join the fun, right? And so it's the same thing with the tax code. Most people can't understand the complexity of the tax code. You look at the tax code, you open a publication, all you want to do is start snoring, right? But for me, I open a tax publication and I get excited. So it's my language. So you need someone in your corner who knows the language and who can translate the meaning of the code to you, so that you can now take advantage of that and go create wealth for yourself and your family. So the tax code leans heavily towards entrepreneurs and investors. Not so if you're an employee, I'm sorry, you're up a creek. Basic deductions, and most of them max out or phase out at really low income, which the IRS considers to be high income, right? So you phase out of that, and most of the time you're an employee, you're paying more taxes than someone who's in a business bringing in maybe 500,000, bringing in $1 million, and you're paying more money as an employee who's bringing in half of what they're making. That's because if you're in a business, you're helping the government create and provide social services, so they're giving you benefits for that, right? They're rewarding you for that. And so the one big beautiful bill is no different. It is geared a lot more towards investors, entrepreneurs, than it is geared towards individuals and employees.
Yeah, that is so good. I love that analogy. Being in a party where you don't understand the language and everybody's having a good old time. Because I've been in those situations where you're like, wow, they're all speaking Spanish. Yeah, I don't speak Spanish. So I love that. I can really relate to that. So if you could highlight really quick, if somebody is a high income earner and they are a W-2 employee, are there some things that they could do that maybe they could chat with you about? How can they start implementing some advanced tax strategies, maybe starting a business, starting an LLC, something like that?
So I tell most people, especially if you're an employee and you're a high income earner, a side hustle is not an option. It is a requirement, because a side hustle is a business, and it now gives you access to deductions, credits, strategies that you have no access to as an employee. So whatever your skill is, figure out a way to monetize that skill. And if you can't monetize that skill and turn it into a business immediately, what other business can you start? What other side hustle can you start up while you're working as an employee? Your side hustle is creating income, but it's opening the door to you to more strategies that you can use to leverage against your employee income.
I love that. It's not an option, it's a requirement. It's a must do, especially for our high net income earners, W-2 employees. So you were telling me that some of these provisions in the Big Beautiful Bill are going to be retroactive to January 20th. So it sounds like we should have a sense of urgency on some of this.
So the retroactive, it's not really what creates the sense of urgency. It is, we are in July and tax planning happens. Everything must happen before the 31st of December. Like most strategies, you need them implemented before the 31st of December. And so the speed requirement here is that you have 5 months left to implement, so that you can take advantage of these strategies. It's not really the retroactive, it's the time left between now and December.
Okay, so that's the sense of urgency. That makes perfect sense. So let's kind of unpack this. Bonus depreciation is now 100% bonus depreciation. So let's get started with that and take it from there. Can you share that in simple terms? You know, we're not all tax professionals like you, but you know this like the back of your hand. But for us mere mortals, can you break it down for us?
Okay, so I'm going to try to do this as simply as I can.
Okay.
So bonus depreciation is a provision that is given by the tax code that allows you to depreciate the value of an asset in the year that the asset is placed in service. It just means that if I started the use of an asset in 2025, I can reduce the value of this asset 100% in 2025. Now, why is that such a huge thing? So say, for example, if it is equipment. So let's say you own a construction company and it is equipment. So you purchase equipment and you purchase $1 million or $1.2 million worth of equipment. You can take that $1.2 million deduction in 2025, reduce your taxable income by $1.2 million. And if you're a C Corp, that's a 21% tax break because it's 1.2 million times 21%, right? So that's a huge tax break in the year that you place it in service. So most assets are on the maker's moderated accelerated cost recovery system. So what that means is that there's a certain time period where you have to depreciate that asset. It loses value over a certain period. So some of it is 5-year property, 7-year property, 15-year property, 20-year property, right? So you depreciate it, which means you reduce the value over those years. Bonus depreciation allows you to reduce the full value in 1 year.
Wow. That's incredible. So it was 40% and now it's 100%.
Mm-hmm. So bonus depreciation was 40% for 2025. It would have been 20% in 2026 and phase out completely in 2027. No more bonus depreciation. But now it's back to 100% and it is permanent. So no more phasing out. Bonus depreciation exists permanently until it is repealed by another tax bill or whatever. But for now, it is permanent.
Wow. I mean, this almost sounds too good to be true. So what's the catch? I mean, there's got to be some special qualifications.
Okay. So here's the catch. So most people hear bonus depreciation and I can depreciate an asset's full value in year 1. And they're like, okay, I'm going to do that. I'm going to get a huge tax break and that's it, right? But again, not because you can do something means that you do it. That's not the case. You have to think about, you have to weigh this, right? The thing that most people don't think about is recapture. And what recapture means that if you receive bonus depreciation on an asset in 2025 and you sell that asset in 2026, IRS says that you need to pay me back that depreciation. What that means, they're going to tax you on the sale, including the depreciation amount, and it is at ordinary income, ordinary taxes. So it's not capital gains, it's ordinary. Wow. So if your tax bracket is you're in the 47% tax bracket, you're going to pay 47% on the recapture. So that's what people have to be, that's what you really have to be cautious about. It doesn't mean that I can just buy an asset in year 1 and sell it in year 2. So you're going to have to keep the asset for certain periods to avoid or reduce recapture.
Okay. So it sounds like, well, I love that you said, just because you can doesn't mean you should. Because a lot of times people come to me and they've heard about this special thing on TikTok or social media, some tax strategy, and they want to use it. But just because you can doesn't mean that you should. This is all custom work. This isn't a cookie cutter, one size fits all. So let me ask you, you mentioned, so does this work on both new and used equipment? Is that the case?
Mm-hmm.
Okay.
Yes, but one other thing before we even move on to anything else. So the bonus depreciation, most people, you mentioned social media, and that got me thinking. That is the thing that's being talked about the most on social media. Even before it went back to 100%, everyone is, I'm going to buy a vehicle, or I'm going to buy, I think a couple years ago it was, I'm going to buy this G-Wagon, $100,000+, and I'm going to depreciate it. But here's the thing, what they're not thinking about is you get the depreciation, yes, you get the tax break, yes, but can your business afford the finance agreement? Can you afford to pay the monthly payments on that vehicle? How is it going to impact your cash flow? How's it going to impact your growth? So this brings us back to, just because you can do something doesn't mean that you should.
Wow. I heard that so many times. I saw that everywhere. That was a couple of years ago. I did. And everybody's buying these these vehicles and everything. I'm going, gosh, I don't know. This doesn't sound right to me. So I'm glad to know that you're highlighting that. Okay. So a different question then. Section 179 kind of got like an upgrade than it sounds like.
Yes, it did.
How is this different from the bonus depreciation?
Okay, so Section 179 is basically depreciation on equipment that is being used at least 50% in business.
Mm-hmm.
So 50% business use is an absolute requirement. If it's less than 50% use, it doesn't qualify for Section 179.
Oh, that's good.
Okay, so before Section 179 was $1.2 million. That was the maximum that you could deduct in 1 year on Section 179, and then it got an upgrade to $2.5 million. So what that means is in 2025, if you purchase equipment in your business, so equipment off the shelf software in your business, you can depreciate the full amount in the year of purchase. And the other difference is that before, the phase out was at 3,050,000. The phase out is now at 4 million, is now at 4 million. So what that really means is that when you purchase equipment that you purchase up to $4 million, you can get the full Section 179 depreciation. Anything after $4 million, it starts phasing out dollar for dollar until you get to 6.5 million, which means that you won't get any Section 179 depreciation at all. However, when Section 179 phases out, bonus depreciation kicks in. So you can use bonus depreciation where Section 179 falls off.
Wow. What I'm really getting is this really requires an expert who really understands the rules of the game. This isn't something you can put into TurboTax, like that kind of thing. So can we use both of these strategies together?
You can use both. So in the case where, so like the example I just said, if your Section 179 runs out, then you can use bonus depreciation. So you can take some Section 179 depending on how much equipment you purchase, and then the rest of it, you can take that in bonus and expense the entire amount in year one. However, again, you have to think, this is something that is really, you have to be strategic about. If I take all these expenses in year one, what happens in year two? So you have to think about it. So am I going to take Section 179 on a portion of the equipment and then regular makers on the rest of it? So you need it is something that needs to be decided based on your specific situation, not just because, again, the rule exists, so I'm going to do it. But you in business for more than 1 year is long term, and so your strategy needs to be long term as well. So there's different things to consider. And one of those things are, what is revenue going to look like in 2026, right? Based on what's happening in 2025, what is my revenue going to look like? Because your revenue gives you an idea of what your tax bill is going to be like. How do I plan for that, right? So all of these things need to be taken into consideration.
Okay, that's good. I help a lot of like contractors, general contractors, construction. And so let's talk about, like, for a small business owner buying equipment, like big, heavy equipment. What's the practical benefit here then?
Oh, think about this, right? So let's say construction.
I love the way you get so excited.
Let's say construction owner, heavy equipment, and he's like, okay, I plan to purchase heavy equipment in maybe early 2026. But bonus is at 100% this year, and I could use the tax break this year. And being in construction, we do buy a lot of equipment. Almost every year we're buying equipment. So I'm going to go ahead and use bonus depreciation this year. So he's spending, let's keep numbers simple, $2 million on buying heavy equipment. and you can take bonus depreciation on that full amount. So that's $2 million, all of it deducted from his gross taxable income. So now, let's say again, we're going to use two different entity types to calculate the tax benefits. So if he's let's say he's the company is an S corp, which means taxes are passed through, which he's not paying taxes at the company level, he's paying on his personal tax return, and his company is doing really well, and he's in the 37% tax bracket, right? So that is 2 million times 0.37. He just saved $740,000 on taxes.
Wow.
So maybe he is a C corporation, and that's a 21% tax. So it's 2 million times 0.21. That's a $420,000 tax saving. And that's the direct benefit. That's how much money he gets to keep. So now imagine in 2025, I purchased $2 million worth of equipment, and I get to keep $780,000 in taxes because of that. Now, most people, they're like mind blown and stop there because that's it. But that's not it. Because think about this. If you saved $780,000 in taxes and that $780,000 have no impact, nothing happened differently, what good is that? But if you saved $780,000 and now you're with someone who's strategizing for you, let's put that money into some tax advantaged assets, right? Assets that will continue giving you benefits, more tax benefits on top of ROI. So you're getting your return on your investment and you're getting tax benefits that you can use in future years. So imagine how much quicker you are able to build lasting wealth, right? It's not just being rich, it's being wealthy, and there's a difference, right? Being rich, as your revenue grow, your taxes grow. Being wealthy, your revenue grow. You strategize to reduce your taxes because your tax bill is not tied to your revenue. You actually get to determine how much taxes you pay. And I said that to someone once, and he looked at me as if I had grown another head, and he's just looking at me like, what did you just say? And then you get to determine how much taxes you pay because the tax code gives you the legal ability to do so. The most wealthy people in the US pay between 0 and 3% in taxes. They make billions, hundreds of billions of dollars, and they pay between 0 and 3% in taxes. So why are you making 1 million, 5 million, 10 million, and you're paying 47%, 25%, 30%? Why? The same rules are available to them, they're available to you. Same strategies available to them, they're available to you. I tell people tax planning requires two things. It requires your participation. So you are invested. You're working with someone who is helping you have a plan, and this is what we're doing, and you're invested. You're showing up when you need to. You're providing the documents that you need. And investment. If you're able to invest, you have cash flow that you can invest. The more cash flow you have that is available to you to invest, is the less taxes you pay.
Yeah. Man, that was so fire. That was so fire. And that's why when I hear people, they come to me and they say, well, I don't want to make too much money. I say, I don't believe there's any such thing as too much money, because I know that the people are connected to me are good people, and they're going to be good stewards of their money. They're going to hire more people. They're going to pour money into their community. They're going to donate more. They're going to give more to their synagogues. And so I just believe that givers gain. And if we can understand the rules of the game and keep more of our hard-earned money in our own pocket, we will do good things with it.
Mm-hmm.
I just truly believe that. I truly believe that. And I want to welcome Miss Lisa Fabeck. She is our menopause mentor. I think she's really a mentor when it comes to good health, diet, nutrition, And I've learned so much for her. I recently learned that, and I love turmeric. I recently learned there's a certain way to eat your turmeric. If you are a turmeric lover, I'm telling you. So let's kind of talk about now these high, some people that are in these high tax states, like the SALT deductions. You were telling me a little bit about that. Can you break that down for us? Because remember, this is for us mere mortals here. Anybody
Okay.
in the high tax states, I'm assuming like California.
California, New York.
Okay.
Okay, so SALT represents state and local taxes. So the SALT cap before was $10,000. What that means is if you live in California and your property tax bill is $30,000, $50,000, the most that you can deduct from that is $10,000. So if your state taxes are really high and you're paying $20,000, $30,000 in state taxes, maybe more, that is also included in that $10,000. So state, local taxes, so your state taxes, your local taxes, your property taxes, your sales taxes, all of this combined, the maximum that you can deduct is $10,000. That's what it was before.
Wow.
But now it's been increased to 40,000. So it means now you get a break on, you can include more from your property tax, more from your state taxes in the up to $40,000. So instead of $10,000, it's 4 times the amount, $40,000. That's a huge break for people in states like California and New York.
Yeah, that is huge, especially in California here. I know the insurance premiums have just gone really high because of some of the fires and stuff. So this is incredible. I just think this is amazing. You make me get so giddy about taxes. Like, this is incredible. So let's talk about the combination. Can you give us like provisions? Like if you're a you got a 7-figure tax bill, give us like a real live examples. Give us some numbers.
Okay, so before we get to the example, I'd also like to mention the qualified production property, which is a new thing that is in the One Big Beautiful bill. And it is an incentive for businesses, for manufacturing businesses, to, I guess, people to get into manufacturing or to grow manufacturing businesses. And it is also a 100% deduction for those types of businesses. So say, for example, manufacturing, you purchase a building that you're manufacturing products out of. The building can be depreciated 100% in year one. The equipment that you use can be depreciated 100% in year one as well. So that'd be for anything in the manufacturing. So anything with food manufacturing, medications, clothes, whatever, anything in manufacturing. And then also say, for example, like production studios, or so you're creating a movie, you're doing a play, you do plays, stuff like that, then those are 100% deductible in 2025 as well. So that's a huge thing for people in those industries, because again, you get to deduct 100% of the cost in 2025, which means that there's opportunity for making a tax. I'm taking a tax bill to zero. There is. It just depends on what your investment is into those types of assets in 2025.
Wow. Okay, so that's incredible. I can see now why you get so excited about this and you call it a treasure chest, because it really is understanding the rules of the game. Mm-hmm. It really is. We got to think ahead. And if you're somebody who is intending to receive large amounts of money, maybe your business is exploding, or you've just gotten into an industry where you've got this significant contract, and now you're anticipating you're going to have a drastic increase in your income. You definitely got to get with Chris. So let's talk about that case study.
Okay, so let's say bonus depreciation, that's for if you purchase equipment. So let's say, for example, I own a business. Let's use a car, because everyone talks about vehicles. So I purchase a vehicle, not because bonus is available, but because I actually need vehicles, right? So maybe you purchase a fleet of vehicles, and the fleet of vehicles maybe cost you, again, upwards of $1 million. you can take that $1 million in year one, and based on your entity type, it is either $370,000 deduction or a $210,000 deduction. Just depends on what your entity type is. So there's the purchase of vehicles. So okay, let's say for someone who is in real estate, right? So you own real estate, and in order to access bonus depreciation, you need to do a cost segregation study, because cost segregation breaks up a building into its components, which makes them now qualify for bonus depreciation, but the building on its own doesn't qualify for bonus depreciation, because it is 27 and a half years or 39 years, and bonus depreciation is up to 20 years of useful life, right? So the cost seg study makes the property eligible for bonus depreciation. So again, we're using simple numbers, $1 million. Usually a cost seg study will break up the components of that building. You may find that maybe 50-60% of that building qualifies for bonus depreciation. This year, instead of the 60%, which is $600,000 times 40%, which would be $240,000 depreciation deduction, it is the whole $600,000 is depreciation, is a depreciation deduction, right? So there's a huge difference between what you would have gotten if it was 40% and what you will get at 100%. So that's another example. So another example is, let's say for me, real client just purchased a farm, and he's into manufacturing, and he's 7 buildings on the farm. Those buildings will qualify for QPP, the qualified production property, and then the new equipment that he's buying qualify for QPP as well. So now the cost of the farm was $2 million. Let's say by the time he's done with the construction of all the buildings will be like $1.5 million. He can deduct that full $1.5 million, $1 million, and he is an S corporation. And so as an S corporation, 1.5 million times 0.37, not as an S corporation, but because it is being taxed on his personal tax return, and he is in the 37% tax bracket, that's a $555,000 deduction. But that's just on the buildings that they're going to construct, not on the equipment that they're going to purchase. And he's going to purchase a lot of equipment to put in those buildings. So let's say there's another $1 million in equipment that he's going to purchase for this manufacturing venture. So that $1 million now gets 100% depreciation, which is, and his tax bracket is 47%, which is a $370,000 tax bill reduction. So now let's say he had $555,000 from the buildings, and now $370,000 plus $555,000. He just saved $925,000 just using one qualified just the QPP. So the amazing thing about this, right, is that he purchased the farm based on the savings that he got from a strategy that we did last year. We did a strategy last year where he saved $780,000 with that one strategy. Now, instead of doing a happy dance that he saved taxes, he saved all in taxes. The question was, well, what are we going to do to build? Because building is what he's after, creating lasting wealth is what he's after. And so the farm was a direct result of that. And now here comes bonus depreciation, and here comes qualified production property, and he's getting another $925,000 tax bill reduction in his tax bill.
I think most people will take that every single day and twice on Sunday. Who's up for saving an extra $900,000 on their? I mean, this is huge stuff, you guys. We got to stop playing money checkers. We got to know the rules of the game. And I want to welcome my amazing sister from another Mister, Miss Chesda Nuehe. Thank you for joining us. And yeah, I love that you're multitasking. She is actually an incredible representative of Mineral Tree. If you need her services, I highly recommend her. Incredible customer service, impeccable customer service. She actually, her philosophy is to treat every single customer like royalty. And I love that. I love that philosophy. She's an entrepreneur, a budding entrepreneur also as well. So this is something, you see, Chesda, we got to play money chess. So it sounds like there's, this is pretty complex, right? Are there some key steps that someone needs to take to be able to implement some of this stuff?
So the first thing I would say is you have to determine first, it's available, but should I? Right? Mm-hmm. Because if the financial responsibility is going to be too much for you to handle, if it's going to impact your cash flow to the point where it stunts your growth, then this may not be something for you. So you have to analyze where you are, what you're able to do right now, where you're going, and how will it benefit you, right? So if the financial outlay outweighs the benefit, then don't do it. You have to figure that out first. The second thing is, if you decided that, okay, I'm in a place where I can afford to invest X in equipment or X in a property so that I can take advantage of this, the next thing would be, before you go ahead and do that, get with someone who actually knows this, knows the strategies, knows what they're talking about, before just moving ahead and just going ahead and do this. And now there were other things that you needed to consider and you did not consider them. So it is, do your homework, find someone who knows the strategies inside and out, someone to guide you in it, rather than just jump in feet first and then find out later, well, oh, I was supposed to do this and I did that. So I was supposed to zig and I zagged, or I got with someone, but they were the wrong person. And now I have to figure this out on my own, because most of the time when you pick the wrong people, when it's time to figure things out, they disappear. So that's the two things that that's the main two things that I would say. Figure out if it works, if it's suited for you, and then find the right people to guide you through it.
Yeah, for sure. And I will share this. This is what I've seen in my journey, is that this is a question I ask my clients when they come through and I see they have significant tax liability. Even, if they're an employee, 30,000 or more. It's kind of my rule of thumb. If they're paying more than 30,000, then we kind of want to really take a little bit of a closer look. But I ask them, when was the last time your tax professional gave you a recommendation that they do time, money, or taxes? And if that answer is never, it's probably worth another conversation to find somebody who really is a strategist. And I'll tell you how I got really interested in taxes is because I had a client who, his father was brilliant. He purchased a property for himself for every birthday for like 35 years. I'm talking about prime real estate in the Silicon Valley, Facebook, Google, all of this prime real estate. And so they amassed this incredible real estate fortune. And I always asked him, hey, do you guys have everything taken care of? Do you have a living trust? Do you have somebody that's handling their taxes? And he's like, oh, yeah, we're good. We're fine. Well, when the father ended up passing away, they ended up having to liquidate assets. They had to start selling off real estate in order to satisfy the tax bill, which, by the way, he had to write a check for over $5 million. And I asked him, I said, wow, that, I'm not a tax person, but that sounds really like a lot of taxes. I asked him, did you talk to your tax professional? Like, did they give you any advice? He said, yeah, Leah, they just told me, hey, listen, just write the check. So if your person's telling you to just write the check, it is worth another conversation. I see you're giggling now, so I want to hear from you too, Chris.
So here's the thing about the people that we get advice from. So if you are a high net worth individual, you own businesses, you own real estate, you own assets, and you your goal is to create something that is lasting, people treat taxes as if it is an afterthought. Taxes are your foundation. If you're a contractor, you can't build a house without a plan. You cannot. There's no way. So there's no way that you can actually create wealth, lasting wealth, without a tax plan, because taxes are your number one expense. So how are you creating a plan that doesn't include strategies to reduce your number one expense? How are you going to do that? And then another thing that people don't think about is this fragmented advice that they're getting from everyone. So your financial advisor is over here telling you one thing. Your CPA is over there telling you one thing. The attorney who's supposed to be handling your trust, your legal, and creating your trust and your structure is telling you something else. But you know what is not happening? No one is having a conversation with each other. Now, how are you building wealth that way? So everyone is operating in their specific silos, and they may be getting some results in their silos. But if they were integrated, can you imagine the difference that would make? When my financial advisor is giving me advice on investments, when we're investing in certain vehicles, that my tax person knows what is happening. And so now we can mitigate the tax impact of those investments. When my attorney is having conversations with everyone, we all sitting at the same table having those conversations, because the goal is, at the end of the day, the goal is the client. Where does the client want to go? And how do we help them to get there? And each of us performing in our fragmented silos is not helping that client. Mm-hmm. But together, as a team, taking care of the investment, the taxes, ensuring that the structure is what most people don't think about. Because again, revenue is just one part. Strategy and structure, that's the other part. If you have one, you can have incredible revenue. No strategy, wrong structure, you're in trouble. And you can have two and no structure, you're still in trouble. But add the fragmentation on top of that, you're up a creek. So you invested in your finances more than just, I'm the one earning the money. You have to be invested to the point where I need everyone on my team to be having a conversation. We all need to be headed in the same direction. We all need to know what the other person is doing. That is your responsibility. It's not the responsibility of the financial advisor or the tax person or the attorney. It is your responsibility to ensure that everyone who's handling your finances, we're doing this together, because it's a team sport.
Absolutely. That's totally brilliant. And I talk about that. And that's why I say I'm a financial strategist. In the industry, it's referred to as a family office, which really was probably really for maybe people who are just high net worth, but everyone can get access to a family office right now, because that's what we do, is we strategize, work together with people. So I love that. Absolutely. And then you hand carry them through the entire process, so that we say begin with the end in mind. How are you going to gracefully exit this business? If you just started a business just to close it down, in my humble opinion, you just bought yourself a job. You should be creating a business that's sellable, that's truly, truly sellable. And that, so that you can create that family generational wealth, that family dynasty. So what are some of the timelines? Like, do we need to have a sense of urgency with this? Like, what are the timelines on some of this stuff? You mentioned, here we are already in July. What do we need to be thinking about?
What is the soonest I could get in someone's calendar so that we can start doing this? That is the question. That is the question you need to be asking yourself. What is the soonest I can get on someone's calendar so that we can start planning for this? We can start implementing, because December 31st will be here in the blink of an eye.
Right. Okay, I love that. So we've covered a lot, and I know this might sound like maybe they're speaking a different language that you don't really understand completely, but understand this. If you are paying Uncle Sam lots of money and it's feeling uncomfortable and your tax professional is telling you, just write the check. Just write the check. You have it. Even if you have the money, should you? Or they're just giving you every single type of strategy they heard on TikTok. You want to do that? Sure. And telling you to implement that without really having a true, full, holistic, and proactive plan in place. That may be getting you into a quandary. So be very, very careful. And you know what? With something as important as paying taxes, which is our biggest expense, it's worth a second set of eyes, having a second opinion to make sure that you're not overpaying. So what are some of the final key takeaways that we should know when it comes to like tax opportunities? What would you say, Chris?
So if we're talking about just in respect to the one big beautiful bill, I'd say that this is an unprecedented opportunity to actually create wealth, real wealth, because depreciation is one of the best. It's like one of the best, most powerful tax benefits that you can get. So if you are able to take advantage of any of these strategies, I definitely would do that, because it allows you to free up cash so that you can now invest in more. You can grow more, right? So a lot of people are worried about recapture. Recapture exists, yes, and there are recapture rules. And if you're working with someone who knows the rules, then you will be okay. You just have to be sure that the person that you're working with is educating you about that. And it helps with your cash flow. So the less taxes you pay means that the more money you have to spend either to reinvest in your business, grow your business, again, reinvest in other assets. So if I were someone, even if it was someone, a high income person who had the ability to invest in assets that would bring me this, give me these benefits, allow me to take advantage of these provisions, I would. And if I were a business owner, well, the only way I wouldn't be taking advantage of these provisions is if it was financially impossible. As long as it was financially possible, I would be taking advantage of them.
Yeah, that's good words of wisdom. You've made some new friends here. I know there's going to be a lot of people on Team Replay. How can people reach you? What's the best way for people to contact you?
So I'm on LinkedIn, Christiane Cardi. I'm on Instagram, same thing. I'm on all the social media channels. I am, and I can also provide the link to my calendar to anyone who wants to book. Send me a DM on LinkedIn, and then we can connect. That works.
I love that. And I'm going to deem you the queen of the treasures in the tax code. Okay. Because I just love how excited you are about taxes. Listen, I don't care if I'm going to buy a remote or a pen. I want somebody who enjoys what they're doing. And it's not just that you bring this expertise, but I love the energy you bring to it. I love how enthusiastic this just gets you so excited, like a beautiful present, because
it
really
does.
I know, I love that. And so I know with your clients, you make this process easy, simple. You really put it in terms that they can digest, and you allow them to make those decisions. And one thing I really love, although I love so much about what you do, is if we're going to save this money, we're going to reduce your tax bill and save you $100,000, $1 million, $10 million. It's not just about saving that money and spending that money and buying a new yacht and mansion. It's about investing that money wisely, right? So that you are truly building your family legacy and creating generational wealth and creating a family dynasty. That's really what it's about. Because it's not about how much money you make. I say this all the time. It's about how much money we keep and how much money we pour into future generations. Mm-hmm. Every generation should be better than the previous one. That's truly what I believe. We can do it. But it starts with us understanding the rules of the game. Mm-hmm. So I love this. This has been a fun conversation. You make me enjoy taxes, even though it's something I feel like I don't really understand that well. But you really have helped me so much. I adore you, Chris. I really appreciate the expertise that you bring. So if you're somebody who is feeling like I don't understand all of this, you want a second opinion, please get on Chris's calendar. I know her calendar fills up really, really quickly. And, just as my closing thoughts here is, my name is Leah Garcia, financial strategist. Now you guys understand when I talk about financial strategists, some people are financial planners, financial advisors, or wealth management, and that's all good. But I'm looking holistically and proactively at your wealth. And I talk about protecting, distributing, and transfer your wealth. We got to protect what we build. If we make a bunch of money just to lose a bunch of money, that's not wealth, right? Then we're subject to the gains and losses of the stock market. And then we got to understand, how do we properly distribute our wealth? It's spending it. Because if we have this money and we spend it, then we've really just done ourselves a disservice. We want to protect that seed money so that you can have money that you never outlive. That money that pays you from that seed pays you a lifetime income for the rest of your life. And then transferring this wealth. How do we accumulate this wealth, and how do we transfer it to our family, our loved ones, to our heirs? Maybe you want to transfer it to your grandchildren. Maybe you want to build a family dynasty. Maybe you want to start your own foundation or your own nonprofit. Every family is different. What's important to you? But it comes from knowing what are you going to do? I say begin with the end in mind. It's about playing money chess. We've already done money checkers. We make some money to spend some money. We make some money to pay some money. We've got to start making some money to really protect that seed money and protect our family's legacy. We got to build a family legacy. And I believe that every generation goes along until the one comes along that changes that family last name forever. Folks, it is time for us to flip the script. We've already had generational poverty. I can tell you, I grew up on food stamps and welfare. We got to flip that script from generational poverty to generational prosperity. And I promise you, if you're hearing this now or in the future, I promise you, we could absolutely do that. Wherever you are, if you're starting with a lot of debt right now, it's okay. I can teach you. And if you're starting with maybe too much month at the end of your money, it's okay. You can really go from zero to hero and change your family's last name forever. It is your year to rise up and thrive and make this the best year of your life. So thank you so much, everybody, for joining us. We appreciate you. Thank you so much. If you're Team Replay, please put in the comments Team Replay. And if you watched us live, put it on Team Live and share this with somebody. You know entrepreneurs, you know self-employed people, you know solopreneurs, you know people with high net worth, and they complain about the taxes. That's the person that needs to see this, and the person that needs to get together with Chris. So that's going to do it for us. Thank you so much, everybody. And remember, this is here to rise up and thrive and make this the best year of your life. Thank you, everybody.